If the market and traders are pricing in maybe 3 more hikes this year from the Fed, what does that mean for the direction of yields in the U.S. market now?
You know, I think the market had got itself a little bit ahead of itself, hoping and wanting, a cut. But let's be very honest. I mean, do we really want to cut? What did the cut mean? A cut would mean they'd gone too far. We don't want them to go too far. I think the last year was the year of the great catch-up. This year should be the year of great moderation. So I think if they can just steady as it goes, it actually could be quite good for fixed income. I was joking with a friend, we actually might even get some income in fixed income. So yeah, and steady as you go could be okay. And it's because the market, the economics is good. We shouldn't be that upset, I don't think.
Yeah, it's a strong economy, isn't it?
Yeah.
If we are not, let's assume we're not headed for a recession.
Yeah.
There's been a pullback these last, week and a half or so in global fixed income, whether that's sovereigns or credit, what have you. Is this a buying opportunity?
I think it is beginning to. I mean, the market, again, you're right, the minutes are a bit dated, and the market's kind of taken in its stride, and it's saying, okay, we've dealt with the data, we understand that we have got ahead of ourselves a little bit, and now we're kind of re-examining. But I think for a risk asset, it could be kind of okay. It could be this kind of narrow, soft landing, as what we're seeing, because the economy is so strong. And why am I so kind of bullish on Asia is that as long as we start still feeling like the labor market is tight, how, reshoring and all of that stuff, it really can't happen if you have a tight labor market, right? You still need stuff being produced, and I think that means the growth in Asia still kind of remains this year with China.
I mean, the thing is, it doesn't have to be a landing at all. That's debated here, but it does seem as though there's almost this sort of mentality that, okay, we want them to cut sometime soon and go back to the good old days of free money. And what we're seeing is a process of normalization more than anything else. You need weapons to fight the next battle, do you not?
And I think they want it, right? Do they really want to go back to having no ammunition? No, not really, right? If I was any central bank and I still want a job, it's nice to have a few tools in my toolkit. So I don't think they want to go back down that quickly. And to be very honest with them, I mean, think about what we were fearing last year. We were fearing that we were going to go into a massive recession, right? And now, I guess we still think that is the case, but maybe it's more shallow than we had feared. Europe has not been as bad as we feared. And China, despite all of our fears, is coming out of this COVID situation. So I think if we just take a step back, actually the world is better than what we feared, and we should be okay with that.
I mean, we were just talking to break, right? You can find income in a lot of places now.
Yeah.
I mean, a U.S. Treasury bill is like 5%?
5.05% in 6 months.
I mean, where do you look for opportunities now?
I think we don't think that things can remain, this elevated. I think that's why the curve is inverted. They do see some normalization. Yeah. And we've certainly been seeing clients actually want to lock in some of that because it makes sense in a long-term portfolio, right? Some of those traditional things that we looked for in fixed income, rather than these quick returns, the income component is actually becoming quite an important part of that total return aspect when we speak to clients.